hit you guys with the main takeaways here, with the headlines. So the point here for China is that growth is very much below consensus. Our call for growth is very much below consensus GDP growth. And at the same time, we're looking on the US side, our chief economist is looking for interest rate hikes that are not at all priced in for next year. And when you put those two things together, it's hard to escape the conclusion the renminbi is going to start to weaken. At the same time, we've got the PBOC turning to the reserve requirement ratio as a way of loosening liquidity to keep the deleveraging show on the road. And again, that points to me to the need for the Chinese authorities to allow the renminbi to weaken. On the Japanese side, what we're seeing is that the Bank of Japan is moving towards a kind of cost-benefit analysis mode, where they're seeing very little of the benefits in terms of a sustained rise in inflation, the benefits of their monetary policy experiment, while the fact that this has been going on for so long is starting to cause distortions in financial markets, which the Bank of Japan appears to be very worried about. So we think that their response to that is going to be to focus much more on the elements of inflation which are responsive to the output gap and to capacity constraints, and that would bring the exit much closer. And the second kind of conclusion that we have from that is that the Bank of Japan will take whatever opportunity it can, I think, at this stage, to try to steepen the yield curve in an effort to ward off those building financial risks. So we're going to start the presentation by having a discussion on the trade tension side of things, and why at this stage in the game we don't think that's the major drag to growth in China this year, at least. At this stage, we're more concerned about the tightening of monetary conditions. So if there are any questions there, then please feel free to fire those through, and I'll take them at the end, or to hold off until the end, and then you can ask questions at that stage. So our working assumption for what's in the mind of Donald Trump and what he actually wants to achieve is that he does want to get a bargain out of this, and that he's willing to claim victory in whatever way he can. I think at this stage in the game, though, with the threats continuing to roll, we have to start to question that assumption a little bit. Given that we have seen the Chinese making concessions in terms of cutting import tariffs, in terms of making supposedly these high-level negotiations promising to buy more US goods, and also in terms of opening up opening up to capital inflows. Now, we completely we are of the opinion that China really wanted to do most of these things anyway. So we can see really that in the case of imports, China had this critical shift that it made in terms of recognizing that cutting imports is beneficial to the rebalancing of growth towards private consumption, and that they've started to cut imports from last year, and they've promised several rounds of this, most recently with cutting imports on autos and auto parts, which is always a key industry in terms of protectionism. And that's a kind of key shift in mindset that they've made. On the side of financial opening, again, it's clear that China kind of wanted to do this anyway, largely because they've been very eager to accept foreign capital into the effort to recapitalize the financial system, although that has caused some problems in terms of the strength of the renminbi. But it's clear that the Chinese have, or at least that Mr. Trump is pushing on an open door if he wants to kind of claim these things as concessions from China. But again, at this stage in the game, the fact that we're still seeing Mr. Trump being very kind of, I suppose the word is belligerent on the trade war side of things, we have to question that assumption that he's willing to just claim victory for these so-called concessions that China is making. We still at this stage have a few points that allow us to kind of hang on to our base case. The first is that the midterms are coming up in November, so the likelihood is that Mr. Trump has to be, in his mind or in his kind of political way of viewing things, he has to be very aggressive, and he has to shore up that base of his electorate. The second point is that the Trump administration, Mr. Trump himself, Mr. Navarro, has been touting his whole story is very bullish for the US and for growth and for equities. Now, the equity market recently has strongly questioned that view, so it's possible that they kind of pull back at this stage, and certainly the news that we've had so far on the potential for changes in terms of Chinese investments flowing into the US, it seems like Mr. Trump is taking not the hardest line that he could on this particular point, at least allowing Congress to kind of have its say rather than just going down the executive route as he seems to have done in previous instances. The third point that allows us to hang on to our base case at this stage is that we think that the Trump administration will blink before it puts tariffs on consumer goods. So if we're wrong about all of that, then clearly there's a substantial hit to Chinese GDP growth, both through the tariffs on its exports and through its own potential imposition of tariffs on its own imports. So to go through a few numbers here, sorry, just 1 second. Got to clear my throat before the numbers. The quantity of tariffs on the 25% tariffs on 50 billion of imports, that stacks up to about 0.1% of Chinese GDP. The 10% tariffs that Mr. Trump has threatened on 200 billion of Chinese imports, that's about a further 0.2% of Chinese GDP. And then if he also goes for further tariffs on a further 200 billion, then that's obviously another 0.2% of GDP. So if we clock it all up together, including the steel, aluminium, and solar tariffs, which don't really add up to that much, even if you look at kind of second round effects through other countries, then it's about 0.5% of Chinese GDP for the direct impact. Now, in the context of slowing Chinese GDP growth, that's actually a very substantial drag. We have to shade it a bit by the fact that not all of that value added by any means is produced within China, ironically. But we also have to boost those estimates in terms of what will be the actual impact on Chinese GDP by the fact that there are second round effects, that foreign trade is very supportive to domestic trade, and therefore the kind of second round effects and third round effects, that those multiplier effects also will be damaged by the imposition of tariffs. And again, if we're looking at China responding, that will push up consumer price inflation in China at a time when we think that the labor market is anyway weakening. And I think that probably, if they were to meet the tariffs like for like in terms of the quantities that are being imposed, which I don't actually think they would, but if they were to do that, I think that would be the greater drag on their economy rather than Mr. Trump's tariffs on their exports. So at this stage, we think that's all, for this year at least, not our base case. The broader problem is that the US is running a reasonably profligate fiscal policy at this stage. For this stage in the cycle, there's not really any cause for expand more for this kind of fiscal policy, and that really sucks in capital from abroad. And seeing as China is one of the kind of the larger savers, to put it mildly in the global economy, China really is an obvious counterparty to that. And we see the potential for China's current account surplus to broaden, for monetary policy to diverge, as I was alluding to in the headlines there, and the renminbi to depreciate. And these are all things that are going to make evoke a response from Mr. Trump, particularly as we see growth start in the US starting to peak out next year, and the recession is becoming coming into focus on the horizon, at least for 2020 or even the end of 2019. So that's when we see the US and China really on a collision course. But for this year, it's much more the monetary policy, the monetary tightening, which is the problem for Chinese growth. It's worth at this stage just quickly having a kind of a bigger view of things and recognizing why it is that China in this cycle is slowing more rapidly than or is kind of leading into the global weakness. And I think that's really because it's China that has had to offset its own financial surpluses over the last cycle. So over the course of the last cycle, the renminbi has been overvalued for several years now, in my way of looking at things. And that means China's much less able to export its financial surpluses in the form of a current account surplus, which has decreased as a percentage of GDP. And as a result, they've had to run internal deficits. And we've seen that then means that they are the ones that are very much exposed to the Fed's tightening, to the tightening of global liquidity. And therefore, it's the Chinese economy that begins to slow first, among others. But in terms of the major global economies, it seems to be China that is very exposed there. So, sorry, I'm struggling with this cough a little bit here, but just bear with me, please. There's always a lot of talking before you get into the charts, because there's so much going on the political and diplomatic or even undiplomatic front at the moment, but we can now have a look at some charts. So the main reason we have for calling a substantial downtrend in Chinese GDP growth is because of the slowdown in monetary growth, in M1 growth, which is sort of one of our favorite leading indicators for Chinese GDP. The presentation here is slightly marked up because I was having these technical difficulties before we started. So the point that I'm making here is really that monetary growth here was probably a little bit overstated because of various things that were going on there in terms of moving categorizations. But the downtrend, even if you kind of discount this peak, is still very kind of clear here. That we're seeing a steep downtrend in monetary growth. And that really goes hand in hand with what we're seeing in terms of producer price inflation. Here we've got a substantial downtrend in PPI inflation. We're likely to see a bit of an uptick here, mainly thanks to actually almost exclusively thanks to the combination of base effects and the upswing in oil prices that we've seen since the middle of last year. That really ebbs very, very rapidly in Q3, and the base rose much more rapidly last year from about August onwards, and that's where we get this downtrend or resumption of the downtrend here in towards the end of the year. Underneath this kind of headline story, we have manufactured goods, where the producer price of manufactured goods has continued on a downtrend. There's some kind of crazy things going on here with some of the sub indices, but the overall story is one of slowing inflation, but that has missed this kind of little uptick that we've started to see in the headline. The disinflation, the slowing of inflation that we've seen is not just limited to the industrial sector. it's also here in the services sector. So the trend here is a little bit harder to see because of these blips that we see around the Chinese New Year, which are just generated by travel in different months of the year. But this downtrend is, I think, likely to continue because we see the labor market starting to weaken there. Now, what is really causing this slowdown in monetary growth, this tightening of monetary conditions? On the credit side, it's the household sector which has been the sort of swing borrower in this last mini cycle since 2016, when we saw the property market starting to go through a little boomlet again. But the household debt growth has really started to slow here. Now, there were some kind of regulations imposed in December last year on microloans, and we think that's also curbed conventional lending. The peak back here is where we see the property market starting to pick up again, but we're certainly here on a downtrend, and that really is driven by a combination of the curbs that the authorities have put on, both in terms of ability to borrow and in terms of making it more difficult to flip houses as financial assets, because that's where a lot of the destination for a lot of these funds. But also it's a sort of lagged effect of the rise that we saw in yields last year in China. This is our kind of extrapolation of the rise in yields to mortgage rates. And that kind of fits pretty well, showing a downtrend here. It has now started to level off and should kind of pick up again here because of the decrease in the 10-year yield that we've seen over this year. This axis is inverted here. So that is one kind of thing in favor of household debt growth, at least starting to level off now. But on the shadow banking side of things, there doesn't seem to be any let up at this stage. Now, what you normally see in China when in this chart, if I extended it back a bit further, would be whenever there's a kind of weakness in say for undiscounted bankers' acceptance bills, then the authority, then entities, business entities find other ways of financing themselves. So there's a sort of an offsetting position. What we've seen more recently is that each of these different kind of, I nearly said conventional shadow banking instruments, but the kind of the tried and tested shadow banking instruments they've cracked down quite hardly on those, quite stringently on these more recently. And what we're seeing is a bit of a resurgence in net financing of corporate bonds here. But that is really just offsetting what we've seen in offshore markets, and there's a bit of a story going on there, which feel free to kind of ask about in the questions if you are interested in that. So what is the PBOC doing about this tightening of monetary conditions? Do they think that they've perhaps overdone it a little bit? I think the answer to that is yes. We've seen them stepping back from the mini hikes that they've done. They didn't follow the Fed in June here. We've seen that they've managed to get interbank rates down off of this ceiling here. So that more recently, there have definitely been spikes, but they're not continually having interbank rates along the ceiling of the corridor. So that's one kind of element to what they're doing. They're no longer having their little 5 basis point mini hikes after the 25 basis point hikes of the Fed. Within the open market operations, we also see that they've been more they've been loosening somewhat here with their net interbank injections, and these include the reserve requirement ratio cuts. That's our kind of estimate of what the implications are here in terms of the targeted and temporary cuts that they did earlier in the year. We can kind of, if there's any questions on kind of the breakdowns here, then please kind of feel free to ask. But I don't want to spend kind of too much time on the details here. The main point is that the PBOC has been more easy in terms of its interbank injections. So where we sort of get to at this stage is that they're no longer following the Fed up. They've made a very significant expansion of the collateral that they'll accept in the medium-term lending facility, which basically means that the banks can rely much more actually on the PBOC, either by providing SME loans as collateral, or kind of lower rated corporate debt as collateral. And these are all ways that the PBOC has in recent months, just in the most recent months, started to loosen up on its position in open market operations. We've also heard, again, just very recently, that there will be more fiscal support for SMEs. It seems likely that they'll go ahead and spend a bit more on cleaning up the environment, because that's a good way of stimulating without causing pollution. In fact, it reduces pollution. And the major way that eventually we see them kind of loosening up here is just, again, by not following the Fed, and the fact that the Fed is likely to continue hiking quite aggressively. Then what we get is that the PBOC has to countenance a larger amount of capital outflows. So what we'd seen in Q1 was more clear actually on the balance of payments, that this was a net inflow Q1 overall. There was the beginning in the most recent data of outflows again, and I would expect that we start to see outflows re-emerging here, and that the PBOC sort of countenances that in order to allow the renminbi to continue depreciating. And this is a kind of a broader kind of 18-month story. I know that the renminbi has moved a lot recently, but this is a kind of a backdrop to that trade tensions story. Now, I think at this stage, again, it's a good idea to step back and work out really what it is that's going on here. What we see is the renminbi in overvalued territory, as I mentioned earlier. This is Chinese relative unit labor costs in the orange line here. That's just Chinese unit labor costs relative to the major trading partners on a trade-weighted basis. And we see that China's just lost a huge amount of competitiveness here. So they've managed to carve a bit of that back recently, and this was mainly through kind of demand deflation here. But what we see now is that they have sort of two ways out of this. Either they can allow the renminbi to depreciate nominally, or they have to go into deeper producer price, deeper slowdown in producer price inflation in order to ward off that pressure, that downwards pressure on the current account surplus. So we have seen a continued decline in the current account surplus there. If I can run this back as a percentage of GDP, remember that the current account surplus before the financial crisis was above 10%. So we're very much lower than that now. It has been kind of 2 to 3%, and actually in Q1 on an unadjusted basis, it was down in the deficit range, which was probably, and we'll see a kind of a rebound in the unadjusted data in Q1, but nevertheless, that tells you how much things have changed in China. A lot of it is about this downtrend that we see in the tourism balance. There's a kind of a statistical blip there, which we can kind of look through. But the tourism balance has declined, and that's just about Chinese households having more purchasing power than they have done previously, going back to that chart that we had on the unit labor costs. Now, you might be at this stage asking yourself, well, China does still have kind of a current account surplus. So why is it that I'm saying that the renminbi is overvalued when they're still running a current account surplus? Well, I think for that we have to look at the microeconomics of the story, and recognize that China still is in that part of the firm's cycle where it may not make sense from a longer term perspective to continue in operation, but you have these high fixed costs which mean that you should just continue churning out goods, and a lot of those goods end up as exports. So that is a kind of a booster to the current account surplus, despite the fact that the renminbi remains overvalued. I think that the rebound in producer price inflation that we've had recently, until very recently, was mainly driven by a kind of global commodities phenomenon, and also by a bit of nominal depreciation. So that doesn't really tell me that the renminbi is sort of out of the woods and that it's reached a undervaluation territory. And I think really what we're getting to now is that the currency does remain, the underlying kind of drift of the currency is overvalued, and therefore they have to either choose nominal depreciation or they have to choose demand deflation. And I think when push comes to shove, what they will choose is that gradual depreciation. Now there's several ways that they could kind of respond. They don't really favor clearly allowing the deeper depreciation, the sharper depreciation. They historically, and I think probably still to this day, certainly seem to favor allowing things to happen gradually. And I think that's where we see the reserve requirement ratio coming in as their preferred tool for keeping the deleveraging show on the road. So let's think of what the counterfactual here would be. China could either deal with its legacy of bad debt by for instance, issuing government bonds and having the PBOC print a lot of money and using the government bond, using the money that is released, for instance, by a much deeper cut in the reserve requirement ratio, to allow banks to purchase those bonds and by that method recapitalize the banking system. So that's the kind of the big bang approach. And it's very unlikely that a government would do that on the front foot. It's more likely that they'd have to be pushed into it. Now, it could come to that over the next kind of 2 years or so as the Fed continues to hike, and then eventually as global demand starts to slow, that China could go for a kind of a big bang TARP-like almost measure. But that would be in my mind, at least initially, that would mean a sharper depreciation of the renminbi, because it would involve releasing a lot of these reserves that have been tied up, or the PBOC simply printing a lot of money. So that's the kind of the counterfactual at this stage, but I still think that might actually happen if they're pushed into it. At the moment, what we saw in terms of the policy moves that they made over the weekend there on Sunday with the reserve requirement ratio cut, was that they linked it to the debt for equity swap program, which we have our reservations about, and please ask us if you'd like to, but I don't want to take up too much of your time at the moment. But the point here is that they seem to want to just gradually cut the reserve requirement ratio and use the liquidity released by that to provide the liquidity for banks to continue with this debt for equity swap program in a sort of a slow burn debt cleanup that just means a gradual depreciation of the currency. Now, remember, one way of thinking about the relationship between the reserve requirement ratio and the currency is through the fact that it's so high in the first place because China used to hike the reserve requirement ratio to sterilize its interventions when it was trying to prevent the renminbi from appreciating more rapidly. So that was most of what I wanted to say on China there. I'm going to switch through to Japan here and really go through to, I see that question coming up there. I'm just going to take that at the end of the presentation, if you don't mind there. What we've got here is again a tightening of monetary conditions. It's not exactly the same relationship as you see in China, and we're actually less worried about this than we are in China, but we can't ignore it. And it certainly goes hand in hand with the slowdown in credit growth that we've seen. And I think more recently, the reason why we're seeing a continued slowdown in M2 growth is because of the stealth taper that the Bank of Japan has undertaken. Please feel free to ask questions on the precise mechanism by which that works. But at the moment, it seems like the tapering that they've undergone has actually tightened monetary conditions. Now, I said I'm not immediately worried about this, at least especially not in Q2, when I think growth is probably going to rebound quite strongly here. The poor result that we had in Q1 was largely kind of an inventory story. We haven't had a strong performance from private consumption at all in the last 3 quarters. But I think again there have been good reasons for that. When we saw this strong growth of private consumption back in Q2 of last year, that was really driven in large part by big ticket items. And then we saw a drop in mid-year bonuses here, and that really meant that consumers were caught unawares by that, and we saw big ticket items, purchases of big ticket items, really correcting down quite strongly here. The December bonuses were also kind of a bit disappointing, though they did grow. And then what we saw in Q1 was that there was a strong pickup in non-core inflation, which really eroded purchasing power there. So there have been good reasons why private consumption growth has been weak in the last 3 quarters overall. But the point here is that going forwards, growth in at least private consumption growth is underpinned by a very tight labor market. We've seen regular wage growth continuing to trend up here, which is quite a remarkable thing if you look how far this chart goes back to, and if I run this back even further, then you don't see this kind of uptrend for a very long time. What we're seeing really is that firms are having to hike wages to retain workers. This is the quits rate here. It's not exactly the same as a US quits rate, but it kind of gives you the idea. So they're kind of keeping their workers by hiking wages. So the threat of moving on and finding a new job is quite a serious one, and it seems to be helping to push up wage growth. Now, there's been a few kind of crazy things happening in the labor market data. There were a lot of blips in around the beginning of the year, which this went along with a significant drop in the unemployment rate down to 2.4% from, I think at that stage, 2.7 or 2.8% in December. And that is partly probably to do with something to do with sampling. But it also sort of fits with what we were seeing in December here with very, very strong job openings. So in the last in the few months of data that we have for this year so far, firms have really been trying to fill these postings that they made back in December here. So there's been a significant tightening of the labor market. The PMIs point to a continued tightening through into for the rest of this year. So the regular wage growth is likely to continue to trend up. The problem is, from the Bank of Japan's perspective, that it's just taking too long. Inflation, core inflation in particular, is just nowhere. These two little kind of blips of hope that we saw here were mainly actually to do with transport inflation and communication. Now, transport was a kind of lagged oil effect, and actually that should mean that core inflation will start to trend up again from here. And communication seems to have been some strange things going on there, but that seems to have reverted back down again into communication price deflation more recently, and that could go a little bit further. So while the monetary policy experiment seems to be taking too long, at the same time, we're seeing financial risks building, and we're seeing the Bank of Japan Financial System report talking about this, the IMF Global Financial Stability Report also. We've had Kuroda talking about the lack of profitability in regional banks pointedly almost whenever he speaks since the end of last year. And we even had Amamiya coming out recently and talking again about this kind of this cost-benefit analysis that they're having to do now. What are these financial risks that are building up? So this is BIS data on total claims, and Japan's share of those claims has risen very rapidly recently. Now the problem with that is that a lot of this is funded by very short-term U.S. government debt. Sorry, not government. U.S. borrowing in U.S. dollar markets, and the nature of that borrowing has become more risky. So this actually is a little bit more scary than we need to be in terms of the expansion that has actually been undertaken by Japanese banks, because Japanese banks are expanding here and kind of stepping in to fill the breach where European banks have really stepped back. So European banks kind of learned their lesson in the subprime crisis, that borrowing in short-term dollar markets and lending into, in their case, the US subprime market, in Japan's case, probably EM assets, and also there's likely a China exposure there. We saw Mr. Koichi, who used to be on the BOJ board, coming out and saying that he was worried about Chinese developer debt, not necessarily linking it to Japan, but it's certainly something that they're watching. So it's not as bad on these metrics as it was before the subprime crisis, and we're really now starting to see a kind of a global shift towards building these types of imbalances in the dollar balance sheet. But the caveat in Japan's case is that the borrowing that they've undertaken in terms of US dollars has become is a lot more risky. A lot of it is through FX swaps, which is a very kind of volatile form of funding, and also the providers of those FX swaps have become a lot more. It's likely that they behave a lot more pro-cyclically, because global banks have had to pull back on their activities in these types of markets. Hedge funds and sovereign wealth funds have stepped in to fill the gap, and those guys are a lot more pro-cyclical. Feel free to ask questions on that. I'm not going to do much more on that right now. So how does the Bank of Japan respond? They initially respond, I think, in the next few months, certainly from Governor Kuroda's comments in the press conference, that they will be focusing on those elements of inflation which do respond to capacity constraints. The second way in which they're likely to respond is to try to steepen the yield curve, because the flatness of the yield curve and low interest rates in Japan is really what's driving Japanese banks and Japanese life insurers to go abroad and to undertake these riskier practices that are starting to cause the Bank of Japan concern. So the thinking goes that if they start to steepen the yield curve, they reduce the incentive for these financial distortions to build further. So here's our kind of broad summary of the thinking and the main themes there. We have I'm just going to check through for some questions here, and please feel free to ask any questions at this point. So one question that we've got coming through here, Chinese GDP seemed to outperform in H2 of 2017 and began to underperform in the H1 of this year. The monetary and credit pictures do not support the 2017 outperformance story. Is the economy detaching, lagging from the traditional monetary levers? Will new measures be able to offset the weakness? So I think, yeah, you're absolutely right. There was strong growth last year, certainly above 6%, and this year I think we're going to be moving below 5%. So it's really a lagged effect. That's where we're seeing the kind of the disconnect here. In that first chart, I had M1 growth lagged by about 3 quarters, and unfortunately, these lags are so notorious that they have, you know, the notorious adage is that there are long and variable lags between money and GDP growth, and that's sort of what happens. So I think what we will see is this, as the money and credit data starting to, or the impact of this monetary tightening coming through in the second half. On your point of whether the new measures will be able to offset weakness, I think they're really sailing into uncharted territory on this, because points that we've made in previous webinars are that they're no longer targeting GDP in the way that they used to, in a kind of the obsessive way that if I don't hit this target, then I won't progress up the career ladder. Instead, they seem to have shifted to targeting measures such as PM 2.5, which is a particularly nasty air pollutant, and that means that when they pull the policy levers, they can't just pull the same old levers that they have been doing previously, because they've now set a precedent of having blue skies over Beijing last winter. So they know that by shutting down those polluting industries, as we think they did last year, over last winter in Q4, they can get the desired results of reducing PM 2.5, avoiding that winter spike and getting blue skies. So their policy response this time around has to be much more the open market operations, the reserve requirement ratios. On the fiscal side, certainly trying to support SMEs. Again, the reserve requirement ratio cut was supporting SMEs partially. They've highlighted that in their statements, and also potentially, as I mentioned, trying to direct labor into environmental cleanup. But these are all, it's very kind of difficult for them to know how exactly this will affect the labor market. And we do see signs that the labor market is starting to deteriorate again, having stabilized as a result of that stronger growth in 2017 and to an extent in 2016. The PMIs are showing that the service sector has just acted as this great sponge for the displaced labor in the manufacturing sector, but there's only so long that can go on without just completely crushing productivity growth in the service sector. So the likelihood is that the labor market does start to deteriorate from here, and that's a problem for them. But I think at the moment they will keep the macroprudential side of things going. I think in terms of profits growth, the likelihood is that profits growth is going to be trending down in line with PPI over the rest of this year, though there are some kind of statistical problems that are going on with that data. How do they respond to that? Well, it's not just to kind of pump more into those old guard industries. In fact, it might be to curb supply in those industries to try to support the price and to reduce or moderate the slowdown in producer price inflation. So it's a very different China, a very different type of stimulus that we see them undertaking, or at least switching to an easier stance rather than just pulling on the same old guard levers in this particular mini cycle. If we don't have any more questions at this stage, then I'm going to wrap it up. Again, I'm terribly sorry for starting this late. It was due to some technical problems that we were having, and I hope this has been a useful presentation for you. Thanks for joining.